Why are banks failing us? The once iconic Silicon Valley Bank fell from grace during an era of near zero interest. In this video, I give you 5 reasons why this happened and what we can learn from their mistake. Reason number 1, investment in US government funds. SVB, like many other banks, invested heavily into US government bonds during the era of near zero interest rates. So when the Federal Reserve decided to hike interest rates aggressively to tame inflation, the value of SVB's bond portfolio eroded, resulting in major losses, which in turn led SVB vulnerable to hits that shook the tech sector. Reason number 2, high borrowing costs. The US Federal Reserve's interest hiking spree sent borrowing costs higher, which meant for tech startups that they had to channel more cash towards repaying debt, while they were struggling to secure new venture capital funding. The only way out companies saw was to draw on the deposits they were holding with SVB to continue funding their growth and their business operations. This hurt SVB because there was a high increase all of a sudden of liabilities they were struggling to meet. Reason number 3, the run on the bank. Among maybe one or two other, the run on the bank is a banker's worst nightmare. In the case of SVB, it was triggered when the bank announced that they were selling securities at a loss. And if that wasn't enough, they also said that they would sell something in around $2 billion worth of shares to plug that financial hole in their balance sheets. This announcement set off panic across their customer base, resulting in the customers running to the bank and withdrawing large amounts of money. Now, the result of this for a bank like SVB, who has got this portfolio really centered around the niche market, they were facing a liquidity crisis and asking for external funding to support them. Which brings me to reason number 4, concentration risk. SVB's business was heavily concentrated around the tech sector. In fact, nearly half of US venture-backed tech and science companies were its clients. Now in business, we know not to put all your eggs in one basket, and this is what eventually came back and haunted SVB. They were super vulnerable to changes in the tech sector, and the moment the bubble in the tech sector burst, SVB was hit hard. Coming to reason number 5, which goes a little bit hand in hand with reason number 4, the lack of diversification. While SVB had business dealings in a number of countries, its business model was centered around the tech sector. It did not diversify into other sectors, which could have helped them to overcome some of the struggles they were facing in one particular business branch, which was the tech sector in this case. This naturally left them exposed to risk inherent in that particular single sector. But what can we learn from their mistakes? Well, I personally think it provides several lessons for investors and lenders, which includes the importance of diversification, the need of being very mindful of concentration risk, and naturally and obviously, because history has shown this before with Lehman Brothers, the dangers of investing in government bonds when interest rates are low. Now, history shows us that we need to learn from our mistakes, and if we don't learn from our mistakes, it is just going to be a repeating pattern. These are my 5 reasons why SVB has failed. Let me know your thoughts and opinions in the comment section below. Maybe I've missed something. I hope you enjoyed this video. If so, leave me a sign there, give this video a thumbs up, subscribe to the channel, press the notification bell. Thank you for watching. I will see you in my next video. Peace out.